Hello friends, today let's discuss about the subject and the concept financial accounting. Accounting has been rightly termed as the language of business. It actually records, classifies, analyzes and communicates all the business transactions that take place in a particular period. Indeed, it communicates the financial transactions in a mode of business manner. So let's move on to the module 1, single entry system of accounting. A single entry system of accounting is a form of bookkeeping where each company keeps their financial transactions as recorded in a single entry mode in a log. This process is actually suitable for small business units because of its simplicity and cost effectiveness, and it does not have any it does not require any formal training. This system records the date, description, the value of the transaction, and whether it is an income or an expense, and of course the balance. This system is particular to the concept of single entry mode. Practically speaking, this system is not followed by those firms where there are n number of transactions. Moreover, this system keeps only those essential records, and there is no hard and fast rule of maintaining any particular form of system in this entry mode, and actually it particularly depends upon the situations and how the firm pre-exists the transactions. The basic objective of accounting is to provide useful information to the interested groups of users, both the external and internal. Moreover, the necessary information, particularly in case of external users, that is in the form of financial statements like profit and loss account, balance sheet, etc. And for the management, with additional information from time to time from the accounting records of business. And moreover, the prime objective involves maintenance of records of business transactions, calculations of profit and loss account, and to ascertain the financial position, and of course to satisfy the requirements of law. The main highlights about this system is the economical aspect, it's the suitability for the small enterprises, and here it is possibly quick to record all the transactions. Moreover, it is a very simple method of accounting. Talking about the demerits of this accounting system, the arithmetical accuracy cannot be checked as in a particular manner because of the single entry mode. Moreover, it does not record all the assets and liabilities as explained earlier. It records only essentials, and the true profit cannot be ascertained therefore, and it moreover is not acceptable to income tax authorities, and it's not suitable for limited companies. So there are a number of limitations that over-sustain the merits of this system. Looking at the difference between single entry system and double entry system, we are much clear that the single entry system of accounting is where the record of transactions is made at only one-sided, whereas in double entry system, both the effects of the accounts are simultaneously shown. Moreover, talking about the nature of the entry system, single entry system is simple, where double entry system is much complex as both the effects have to be reflected. And the type of recording, as only one-sided is shown in single entry system, it is an incomplete entry system, whereas both the effects are perpetually shown in double entry system, and therefore it is a complete recording of the transaction. And it is hard to identify the errors in single entry system, whereas it is very easy to locate the errors in double entry system, as both the effects can be easily estimated and overseen. The ledger accounts kept in single entry system are personal and cash account, whereas in double entry system, personal, real and nominal accounts are kept. And preferably, single entry system is much more preferred in small enterprises, whereas big enterprises involve double entry system of accounting. For the preparation of final accounts, single entry system, it is very difficult to prepare the final accounts, whereas in double entry system, it's much easier. And single entry system is not suitable for tax purposes, whereas double entry system is suitable for tax purpose. And the financial portion is not clear and cannot be ascertained in single entry system, and it can be ascertained and easily allocated and identified in double entry system. Talking about the types of single entry system, first type is pure single entry system. In this method, only the personal accounts are maintained and there is no information concerning the sales, purchases, cash in hand and bank balances. The second type is a simple single entry system in which the cash book is maintained along with the personal accounts, and these are maintained as per double entry system of bookkeeping. Cash received or paid from the businesses or debtors or creditors are merely written on the bills issued or received. So simple single entry system keeps both cash book and along with personal accounts, whereas in pure single entry system, personal accounts are only maintained. The third type is a quasi single entry system. In this, subsidiary books like sales books, purchase books, bills receivable books, bills payable books are maintained in addition to cash book and personal accounts. So there are three kinds of books maintained in quasi single entry system, that is subsidiary books along with cash book and personal accounts. Statement of affairs. What actually does the statement of affairs do and what is the key purpose? Statement of affairs is a record of financial portion of a particular business entity at a given time. So the main purpose of statement of affairs is to afford the relevant information for the interested parties such as the shareholders, customers, employees, competitors, etc. It actually exhibits the amount at which the organization can recover after selling off their assets and settling all their obligations. Taking the difference between profit and loss account and statement of profit and loss. Profit and loss account, as the name suggests, is an account, and an account is where all the business transactions of the same type are entered, whereas a statement is something that supports a business transaction or transactions. Profit and loss account are prepared on the basis of double entry, that is, it reflects both the debit and credit aspect, whereas statement of profit and loss account is based on single entry. And moreover, profit and loss account takes into account purchases, sales, returns and all expenses and income from ascertaining profit or loss, whereas statement of profit and loss takes into account closing and opening capitals for ascertaining profit and loss. Moreover, profit and loss account is prepared from ledger account balances only, whereas statement of profit and loss is prepared partly from ledger account balances and partly from estimates. I hope the concept of single entry system is clear. It is much prominent among small enterprises as compared to the double entry system, which reflects bigger transactions in bigger enterprises. Thank you. Over to our second module, company accounts, issue of shares. A company may be viewed as an association of persons who contributes money or money's worth to a common inventory and for a common purpose. So as it suggests, company is formed for a common purpose, or in instance for a particular purpose. It is an artificial person having a corporate legal entity which is distinct from its owners, that is the shareholders, and also has a common seal used for a signature. So the special features of a company is distinct in different forms of the organization. Talking about the books maintained by companies, it includes cash book, journal, cash flow statement and ledgers, financial statements such as profit and loss account, balance sheet, trading account, then copies of bills or receipts, records of sales and purchases, and a record of assets and liabilities. A company, as mentioned earlier, is an artificial person, and therefore it cannot generate its own capital, and which is necessarily to be collected from several persons, and these persons are known as shareholders, and the amount contributed by these shareholders is the share capital. Since the number of shareholders is very large, a separate capital account cannot be opened for each of them, and hence the capital contribution is merged into share capital account. Now let's look into the different phases of capital. Authorized capital, it is the share capital amount that actually has been authorized by the company's memorandum of association. Issued capital is the share capital amount that a company issues, and subscribed capital are the amount of share capital that the public subscribes. Called up are the actual share capital that a company calls upon, that is, it is called upon from subscribed capital. And paid up are the amount of share capital that actually the shareholders pay from the called up capital. And uncalled are those which has not been called yet, which are still to be called upon and paid upon. And reserve capital is a part of uncalled capital. These are kept apart, or the portion of the uncalled capital is kept especially for the purpose of winding up of the company. The difference between reserve capital and capital reserve, this is an important aspect in financial accounting. A reserve capital is the portion of uncalled share capital that can be called up by the company only in the event of liquidation of the company or the winding up of the company. And capital reserve is a portion of the profit set aside that can be used for a specific purpose only. So that is the main difference between reserve capital and capital reserve. So capital reserve is a part of the profit, and reserve capital is a part of the uncalled share capital. And there is a compulsion in the creation of capital reserve by every company, which is not that in case of reserve capital. And the capital reserve has various uses like writing off fictitious assets, capital losses, etc. But reserve capital is used only at the time of winding up of the company. What are shares? Shares refers to the units into which the total share capital of a company is divided. Actually, a share is a fractional part of the share capital, and it forms the basis of ownership interest in a company. The persons who contribute the money through shares are called as shareholders. There are mainly two types of shares, that is preference share and equity shares. Equity shares are also known as ordinary shares. Preference shares are those shares on preferential rights. Redeemable preference shares are those preference shares which are redeemed either at a after a specific period or earlier adoption of a company. Sweat equity shares are the equity shares which are issued by a company to its directors or employees at a discount or for consideration other than cash, for providing their know-how or making available rights in the nature of intellectual property rights or value additions or what so may be called. Sweat equity shares is one of the modes of making share-based payments to employees of a company. Under employee stock options scheme, companies offer their equity shares to their employees, and that is with an option to the whole-time directors, officers, or employees to purchase or subscribe the equity shares at a future date for a predetermined price. And these rights are exercised by the employees during a specific period, and there is no obligation among the part of the employees to exercise this option. And the main focus of employee stock option scheme is to build the part mode among the employees and to motivate the employees. Minimum subscription is the minimum amount according to the directors that must be raised to meet the needs of the business operation of the company. This may relate to the price of any property purchased or to be purchased, or the repayment of any borrowed money by the company, and of course it may be also related to working capital. Shares issued for consideration other than cash. When a company enters into an arrangement with the vendors from whom it purchases assets, whereby the latter agrees the payment in full form of paid shares of the company which are issued. In other words, there is no cash receipt for issue of these shares, and these shares can also be reissued at par or premium or discount, and the number of shares to be issued will depend upon the price at which the shares are issued and the amount payable to the vendor. Forfeiture of shares. It may happen that some shareholders may fail to pay any of the call money or allotment money, and in such cases the company can forfeit these shares. That is, they can cancel their call money or allotment money and treat the amount already received as forfeited to the company within the framework of provisions of the articles of the company. Surrender of shares simply means the return of shares by the shareholder to the company for cancellation, and this power of cancellation by a company can be exercised only if it is given expressly by the article of association of a company. Here we have discussed few of the concepts that comes under the issue of shares. These are the highlights in the concept of company accounts. I hope the concept is clear. Thank you. Module 3, Accounting for Issue of Debentures. Debentures are issued to the public as a contract of repayment of money borrowed from them. A company can borrow money for meeting its short-term as well as long-term requirements. For meeting its short-term requirements, a company usually borrows from bank by way of loan, overdraft, or cash credit. For meeting long-term requirements, a company borrows from the public by way of issuing debentures. Debentures are of different types. Some of them include secured debentures, unsecured debentures, redeemable debentures, irredeemable debentures. Secured debentures are those debentures where a charge is created on the assets of the company for the purpose of repayment in case of default. Unsecured debentures which does not have any specific charge on the assets of the company. Whereas redeemable debentures are those debentures which are repaid either as lump sum or installment during the lifetime of the company. And irredeemable debentures are those which do not have any repayment access. They are also known as perpetual debentures. Convertible debentures are those debentures which can be converted into equity shares or any other security, either at the option of the company or the debenture holders. Whereas non-convertible debentures are those which cannot be converted into shares or any of the other securities. Specific coupon rate debentures. These are debentures issued with a specific rate of interest, which is called as coupon rate. Zero coupon rate debentures, they do not carry any of specific rate of interest. The issue of debenture is the same as that of issue of shares, which we have discussed in our second module. The company may either ask for the entire amount to be paid on application or by means of installment on application or allotment or various calls. The concepts highlighted here is simple and essential in the course of knowing debenture. I hope it is clear. Thank you. Module 4, Convergence to International Financial Reporting Standards. Meaning of accounting standards. Accounting standards actually improves the transparency of financial reporting all over the countries. An accounting standard is a common set of principles, standards, and procedures that define the basis of financial accounting policies and practices in a company. The major importance of global accounting standards include developing a multinational corporations. Of course, it eventually helps in the growth of international capital market and legislative requirements, which provides a meaningful globalization of the corporates. Components of IFRS. IFRS, the main goal is to provide a global framework for how public companies should prepare and disclose their financial statements, and IFRS provides general guidelines for the preparation of financial statements rather than setting rules for industry-specific reporting. It actually proves a borderline in which the entire framework of a public company should be undergone. Difference between Ind AS and IFRS. IFRS is based on fair value concepts, whereas Indian accounting standards are based on historical cost. IFRS and Indian accounting standards differ in their forms and substances. That means the essence itself is different. This depreciation on revalued assets needs to be routed through income statements under IFRS, and Indian accounting standards define assets by their classes, which can be depreciation on which the depreciation can be meant at a given rate, whereas IFRS promotes the concept of components of fixed assets based on usefulness. These are few of the major areas which need to be highlighted in this module. I hope the concept is clear. Thank you. Module 5, Ind AS IFRS compile financial statements of companies, that is Ind AS 1. Financial statement compilation is a service to assist the management of a business in presenting its statements. Financial statements are the accounts prepared at the end of an accounting period. The preparation of the financial accounts of a company is compulsory under Section 128 of the Companies Act 2013. In case of transfer to reserve, in Companies Act 2013, the compulsory provision has been removed. This means that now the company is free to transfer any part of its profit to reserves it deems to fit. So there is no particular compulsion on the provision to be maintained as a reserve. The company is free in deciding what profit or what reserve is to be kept through its profit. In case of provision for taxation, the provision is made out of current profits to meet the tax obligation. There is a time gap between the provision made and the payment of the actual tax liability, so it serves as a source of short-term finance during the intermediate period. TDS on interest income. When a company receives any interest from investment, the gross amount of the interest is shown in the statement of profit and loss account under the head Other Income. Implied adjustment of interest on loans. When we see a loan account along with rate of interest in the trial balance credit side, we should find whether the full amount of interest is due on loan has been paid or not. So the method to ascertain it is simple, that is to work out the total amount of interest due on loan as per given rate of interest and the date on which it was taken. Compare this amount of interest and the amount of interest paid given in the trial balance. If the interest paid debit balance is less than the total amount of interest due, the difference should be treated as outstanding interest. So this is an implication of the adjustment of interest on loans. These are few highlighted concepts that needs to be understood under this module. The entire conceptual clarity about IFRS, how the issue of shares and debentures are done, and the ways of what share capital is, and what are the different phases of shares, and what are the different types of shares maintained in a company. All these are the basics of understanding a financial statement or financial account, and it only promotes the preparation of financial statement as such. I hope the concept explained in this module is clear. Thank you.